Hello, this is Jim Landman, Vice President of Thought Leadership for Vizient. Welcome to the Kaufman Hall Summer Rating Agency Update. A couple of housekeeping items before we begin. First, you may ask a question at any time during the webinar using the Q&A function on the webinar platform. We'll respond to your question as time permits. And second, a recording of this webinar will be sent to everyone who registered within the next day or two. I'm happy to welcome back our panelists for today's webinar. Suzie Desai is Senior Director and Healthcare Sector Leader at S&P Global Ratings. Kevin Holloran is Senior Director and Head of Not-for-Profit Healthcare at Fitch Ratings. And Dan Steingart is Associate Managing Director, U.S. Public Finance at Moody's Ratings. Today's webinar will be moderated by Robert Turner, a Managing Director and Leader of Kaufman Hall's Treasury and Capital Markets Practice, and Lisa Goldstein, also a Managing Director in the Treasury and Capital Markets Practice. And with that, I'll turn the webinar over to Robert.
Great, thanks, Jim. Hello, and welcome back to our latest installment of the rating webinar. We're so glad that you were able to join us today. Since our last webinar in March, a lot's happened, I think in particular with the passage of the One Big Beautiful Bill. So we want to focus on that today, and we hope that the audience is going to come away from this discussion with insights as to how our panelists view the impact of the passage of that legislation on our healthcare clients. We'll touch on some other structures we're seeing in the market with respect to off-balance sheet debt. We'll talk about merger and consolidation activity and a little bit about capital planning. And so with that, I'll turn it over to Lisa and we'll jump in.
Great. Thanks, Robert. Welcome, everybody. Certainly a lot to cover. And first up will be the bill. It's a little cumbersome to say OBBB, so we'll go with the bill. Suzie, we're going to go with your thoughts first, and that is the first leadoff question is, how will ratings be impacted from the bill? What's your ratings playbook?
Great, and thank you again for having us. It's nice to be here on this very hot Tuesday. So no immediate rating actions as it relates to the bill. We think the time aspect is really key on this. Of course, it's not indefinite time, but it is, these various provisions are coming in over the next 2 to 3 years. So that's really important as we're considering, our list of credits. We have that list. We know what the payer mix it looks like for all those credits. We know the supplemental funding. We've been, you've seen those in our tables. And overlaying that, starting to overlay that with expansion versus non-expansion. We've always been in contact with our state analysts, but I feel like we've got the red phone, to them in terms of just understanding what they're hearing from the provider fee side, because that data is not really available publicly everywhere. So having the, understanding what they're hearing. And then the big piece of the time aspect of this all is that we're talking to all of our credits over the next 12 to 18 months about what they're expecting. They should, now that, we heard earlier on, there was scenario planning and different things going on. Now with the details out there, they should be able to give us a good handle on what the cuts might look like from the supplemental side. So taking that and taking what our states folks are telling us and really looking at how they're going to digest that over the next, as they're sort of planning out over the next few years. The reduced individuals from the, reduced insured individuals, that may be a little bit harder to gauge, and that'll sort of come in waves, depending on what happens with the enhanced subsidies. We might start seeing that next year. But we think that generally that should be spread. There'll be some, potentially higher, the safety net hospitals may have a little more exposure, but generally absorbable. And one thing I should say, we do incorporate special funding in our criteria. And so we have taken adjustments. So not to say that everyone can fully absorb the cuts that may be coming, but we have incorporated that to some extent. So if there's, a smaller amount, perhaps they can absorb that even depending on sort of the overall profile. And I think the other key thing is that we're going to be watching performance now over the next year and a half, and how much flexibility is there on the operating side and on the balance sheet to be able to absorb what's going on. There's still headwinds. We're still not seeing a lot of places back at their targeted levels. We're still seeing, some of the staffing labor, some other things like that. Not going to get the pop on any new special funding that I think a lot of credits have had over the last couple of years. So how are they absorbing what's happened? In light of, sort of the coming gaps that there may be, and what are those plans going into 27, 28. I have a hard time seeing us doing any kind of credit watch, which is typically something we'd have to, adjust the ratings for in 90 days. But as we're getting closer, and if we, as we start seeing that, we could start seeing some outlooks change depending on what the plans are and what the gaps are that they have to fill. But we are going to be talking to all of our credits, so I think that's a big positive that we'll be able to update the market on.
Suzie, you mentioned outlook. So you're currently still a stable outlook on the not-for-profit healthcare sector. Is that correct?
We are still stable on our, yeah.
Okay. And can you just give us some background? How does the stable outlook on the sector for S&P inform or influence the actual bond rating assignment? Are they separate or overlapping?
They are separate. So our sector view is typically how we are thinking credit trends, rating outlooks, maybe going over the next, typically it's, we put them out annually, but we can update that, more frequently as needed. But it's where we think, how much of the sector pressures are going to be driving some of the rating transitions and how much of that could be, at play. So we do look at our ratings independent, we're taking a look at it, but it does inform kind of the lens that we're looking at in terms of the challenges they may be facing. It does influence that aspect of things, but it's more about how, how organizations may be feeling pressure from the sector overall is kind of how we think about the sector view.
And your review of constantly monitoring ratings. On our last call, you had talked about how S&P, how you triage the portfolio. So can you talk through with everyone today what that means, and what if you triage and you find a group of hospitals that are alarming or you're concerned about, what happens next?
Yeah, and I think, again, given that we have some time, we'll be going through our review cycles, unless there's some action that comes out immediately where they say, state of New York, we're cutting rates by, 10%, there may be a little bit more immediate sort of, let's look at these really quickly. I think for the other ones, we have a good handle on how much exposure they have. And then as we kind of go through our review cycles with them, we've been, I think we'll be assessing that a little bit further. So I think it's just having that ability to look at our portfolio of credits, know where they are, but doesn't mean that we're going to be running out the door tomorrow to call them all up and say, I think as of now we're, unless again we see something, because as we've been doing, we've been kind of monitoring the quarterly financials as they come out. Other than that, we probably wouldn't run out the door, quickly asking them to update the rating.
Well, Lisa, if I could jump in just real quick.
Yeah,
I like how you sort of phrased the initial questions. I certainly like all of Susie's answers and agree with them, but you didn't really phrase it like a lot of people do, which is the cuts that are coming.
Yeah, I'm trying to be diplomatic.
Yeah. Exactly. And no way am I defending the bill in any way, shape, or form, or say it's good for us or anything like that. But the reality, it isn't like on X date, 10 million people get cut. That's not the way the bill is structured. There's very little actionable data right now for us to do it. What will happen is it'll make it harder to maintain coverage. And certainly, the CBO has come out with their number right around 10 or 11 million dollars. That million people, what they expect to sort of disenroll. But we don't actually know that's going to happen. It could be worse than that. It could be better than that, meaning fewer people. And so it kind of gives you that left arm, right arm range to play with, so to speak, but not a lot of actionable data. And historically speaking, we've not done a very good job sort of predicting human behavior when it comes to healthcare. And if you go back 15 years, we're talking about the ACA, we all remember these discussions. There's going to be mass, remember the word dumping of patients onto the exchanges, and tens of millions of people, those numbers were thrown around back then. That didn't happen, and so we have to be a little bit cautious before making any snap decisions, I think, on putting a whole bunch of people on rating watch writ large just because the bill's been signed at this stage of the game. Not a lot of actionable data right now.
And Kevin, your sector outlook remains stable as well, is that correct?
Stable,
neutral,
although
neutral.
hey, I do it all the time. We call it neutral here for some reason, and but you can call it stable. And we have not changed it as well after probably the same debate my colleagues have had. We just don't think there, again, is enough actionable data or impact expected for the remainder of 2025. So we're sitting tight at the moment.
Okay. Dan, thoughts?
Yep, similar perspective on, the timing aspect of it. We're still stable as well.
Yep.
Kevin makes an interesting point around the actionable data. We also view it in a similar vein. There's the elements that are going to reduce Medicaid enrollment and eligibility. And yes, we don't know exactly how people are going to respond, but certainly I think a lot of people are going to come off of the rolls simply because of the administrative burden and the churn. The sort of actionable parts of it are also delayed for a few years. You know, we're holding the state directed payments flat now, and they'll start to come down towards the Medicare plus 10 or Medicare rates, depending on what state you're in. But that's several years out, and it's coming down 10 percentage points a year. So you do get that runway of time to react. And to build on something Suzie said, one of the things that we're really going to be watching over the next period of time, I mean, really it's multiple years. I mean, I'm hesitant to say over the next 6 months, 12 months, 18 months, because really it's going to be multiple years, is to see what the actions of individual states and individual systems are. I mean, there's a lot of mitigating actions organizations can take. I would expect, you know, I would think most of the folks on the call here today, they have departments that help people navigate insurance options and sign up for Medicaid when they're eligible and other sources of funding. You know, those departments are going to be expanded. There's going to be roles for there's going to be room for helping people maintain Medicaid coverage and you know, just navigate all the different elements of paperwork or web work, whatever you call it, that are going to be necessary over the next couple of years.
Yeah. Dan, let me refer something that we talked about in March on our webinar. And I think you said it, I think the three of you share the same thought. For some, the bottom line, the literal bottom line is all supplemental funding. A lot of it, average commercial rate, quite beneficial. It is providing the coverage, debt service coverage, and allowing them to have a bottom line. What in a rating committee happens now when you're doing the same calculation and maybe you're looking at a hospital in a state that is ACR? What is the tone around the committee and the discussion?
The question is, what is your plan? How are you going to from today to 2-3 years from now? So we all know that it's a big hole to fill, and there's a variety of levers to pull. You know, some organizations are going to reduce services. There's going to be painful discussions around, you know, reductions in force, other expense cutting measures. But we're not going into the committee simply saying, okay, 100% of your cash flow is tied to supplemental funding, and we know that's going down in a couple of years, downgrade. You know, it's part of a nuanced discussion. So I would expect by the time we got to the committee, we'd have a pretty good sense of what their plan is. And then our discussion in committee is going to be, how reasonable do we think it is? How likely are they to execute on it? You know, I think negative outlooks would be more likely before downgrades. I think, again, the long runway until we really see the dollars being pinched is a big part of how we're going to respond to this.
Okay. And Kevin, per your point, the first thing that is on the schedule will be the absence of premiums for the exchanges. So are you, you know, so far to be effective 1/1/2026, which feels like tomorrow, are you more concerned about perhaps states that did not expand, where exchange sign-up enrollment has been strong?
I think that's, as you say, that's the very first lever to fall. And I do think you'll see some level of immediate impact once those subsidies expire. I shouldn't say go away, they just sort of expire. I think it'll hit just about everybody, even the non-expansion states and the expansion states. I think you'll see an immediate re-leveling, so to speak. What that number is, don't know. Will it be good? No. Bad debt will likely go up, and it takes a little, you know, takes a little whack at the profit margin. Absolutely no doubt about that. So that's the very first thing we're watching, and I think might be a good bellwether to see what happens a few years down the road with some of these work requirements go into place, twice a year recertifications. That might be a good gauge for us, quite frankly. So that'll be sort of like the very first thing that I'm looking at, actually.
Okay. And we have a few audience members today that are health systems. There aren't a lot in the country, but health systems that own health plans. And one of the products is a Medicaid product. Suzie, any new or additional concerns about those particular rated borrowers?
Yeah, I think, and our insurance folks also put out something right after the bill was passed, but it's probably, depending on the concentration, it's a negative to that you may lose folks on the Medicaid side, as well as potentially the exchange side. And to the level, we have a few plans that we look at that are very concentrated on Medicaid and the exchange. Obviously, the more diverse you are, maybe you'll take, you can absorb it a little bit better. But yeah, those plans that are very heavily Medicaid and exchange focused, there could be a kind of a double whammy coming.
Also, as a part of what the plan is, Dan, question over to you. Are you seeing projections? Are they more commonplace today? And are you seeing assumptions regarding the bill? Now, I know it's just July 4th, but as a part of the discussion and assumptions.
I'd say what we're seeing is estimates to sort of help frame the discussion.
Okay.
Sort of the type of thing, if we went down from ACR to Medicare or Medicare plus 10, this is what the impact would be dollar wise. But that's really framing, the most extreme version of what could happen many years down the line. So it's more useful to kind of get a sense of the magnitude of the problem. And we're having discussions now around all the nuances. Well, my county is at this provider tax level, but we do have services in another county that's at a little bit higher. We're in discussions with state officials about how we can move to help find other. I think people are in the exploring stage is what I'm trying to get at. So I wouldn't say that we've seen projections at this point that are really tick and tide.
Right.
But I would expect to see that coming out over the 6 to 8 months.
Okay. And our projection, go ahead.
I say, Lisa, there's an old
Yeah.
adage, right? If you move too soon with, pick a number, 35% of the information, you're moving too soon. If you wait until you have 100% perfect information, you've missed your opportunity. You need to go in that sweet spot, 75, 80, 85%. And I think, issuers that we deal with, to Dan's point, they've just now gotten to that point where they can say, yeah, I think I kind of know where the left arm and the right arm is. And we might feel like we're a little bit in the more favorable category, might feel in the worst category, depending upon our structure, exposure, et cetera, et cetera. And then they can say, now I had all these, tabletop exercises. What if this? What if that? What if that? So we kind of now are beginning to understand the so what. And I think what Dan and Suzie and I are probably all saying is we're getting to the now what. Now what are you going to do? What's the next step? What's the next action? How do you mitigate potential losses or staggering losses, as they might be for some people? And I think we really just reached that point where management teams can get to an idea to start to inform us. I would just sort of jump in. I'm with Dan. I've seen people say, yeah, I got to get the left arm, right arm, but haven't quite turned them into actionable plans just yet, because I just really kind of got this level of detail.
I would agree with that too. And I think we'll see like, hey, this is our budget for next year, and here's our normal kind of things that we're doing to kind of manage our margin. And then we've got, again, to I think what Kevin and Dan are saying, this, could be, anywhere from 200 to 400 million, of cuts that, that we'll have to absorb. And now we're kind of thinking more strategically about how do we do that? Because if it is, to Dan's point, like cutting services and things like that, if they see that coming, that doesn't happen overnight. That's something you got to really plan for.
Suzie, just speaking of, what are some of the more common themes or strategies on expense management or getting ready for this that you're hearing about?
I think it's still early on in terms of the bigger pieces of, is it service lines? Is it doing more joint ventures? Is it, trying to potentially do, kind of the things that we've been hearing about, maybe at a broader scale? Because you've also got sort of the normal kind of blocking and tackling still happening. And are we staffing appropriately? And are we getting the length of stay and all that kind of stuff going through? So I think I think those bigger things that we've been hearing about, that we might have to do this, if things get bad, even like when we were kind of going through a lot of the challenges over the last few years. I think those are the same things that we're also hearing about now in terms of that, how to manage through this, potentially as it comes through.
Yeah, to piggyback on that, I think one of the things that's concerning is the recovery is not complete. And the last several quarters, frankly, have trended down. So we're coming into this not in, maybe not from a place of weakness, but certainly not from a place of strength. So I know we've got a couple of years until this stuff really hits, but the trends in recent quarters are going in the wrong direction.
Okay. So we actually have a question related to the bill. So let me go ahead and ask it since we're talking about it. Will the bill be impacted from midterm results, midterm election results? Anyone's guess, game, thoughts?
Yeah, I'll jump in. I mean, personally, I think probably. I think there's a lot of anger out there in the voting public for a variety of different reasons, and what was actually in it, and did you support it? Obviously, like the ACA 15 years ago, really sort of a very contentious down party lines split with a few people sort of moving over the aisle, so to speak. So it wasn't like this bill has a mandate or anything along those lines. Could it be subject to revisions? I absolutely think that's the case. I don't think anyone that we're dealing with is going to hope for that. As we always say, hope is not a strategy. It's nice to have, and if you don't have it, it's pretty sad in life. But the reality is it's not going to fix things for you. So go with what you know. We now, again, keep saying this, we kind of know the left arm, right arm, or we will soon, so to speak. And then you start working backwards from there. If this is our maximum hit, how do we start to mitigate that strategy? And a couple of us have already said, some of the states are going to have to kick in just a little bit, or there'll be an expectations that the states will kick in. So again, just not this across the board answer to it, but I don't think anyone's just going to let's just hope for midterms. It's going to go away. It's going to get better. I mean, it's okay to do that in the dark of night when no one's watching, but I would not do that, at your town hall meetings or anything like that. Have actionable plans so that we can gauge what that impact's going to be, because I know you guys are doing it internally. You have to do this with both fingers.
At night in the dark. Okay.
Exactly.
Yeah. Not in a boardroom. Right?
Not in a boardroom.
Yeah.
Exactly.
Well, let's pick up on capital spending for a second. I guess, the idea that bad news is better than no news, and maybe now there is some degree of clarity, right, with the passage of the bill. Do you have a sense yet as to whether, and this maybe we'll start with you, Kevin, but do you have a sense yet whether organizations have begun to chart a new course with respect to capital investment? I know we say it's too soon and it's going to take time, but I mean, is there any sort of sense that maybe we're out of the woods a little bit on some of the worst case scenarios? What's your read of that?
Yeah, so there's a lot of catchy phrases you can use, but I think leading into the signing of the bill and the expectation, the back and the forth of it, the numbers that were thrown out were very big. I think we all heard, 8 million to 10 million to 12. I read an article that said 17 million people, again, being disenrolled or choosing not to renew their enrollment. And those are big numbers on top of the uncertainty of tariffs and maybe 340B and site neutral. There's a whole lot of miasma of uncertainty going in. I think it's narrowing down a lot more, and I think we've got a little bit of a stay of execution or a whole lot of runway that we've been using. Take a deep breath. We've got some time to figure this out. I think all of that sort of is in play. And I would say that capital spending, and I relate that interestingly enough, when we were through the worst years in 22, 23, part of 24, with staffing issues, labor issues, capital got curtailed quite a bit. And then, it's median season. We've all probably done our preliminary median runs. I have. And what jumped out at me and probably my colleagues is there was a huge jump last year in spending on capital. So there was this backup need that we sat on the sidelines for a long period of time. And I just don't think we can sit on the sidelines for an extended period of time again. So despite the uncertainty, look, there's plenty of really strong credits in all of our portfolios and name brand institutions, and hopefully they're all turning in today, that they're going to keep on chugging. And they're also going to find this as a buying opportunity for them, an expansion strategy. While others are weak or down, I'm going to keep moving on. So I really don't expect any fundamental shift in capital spending or borrowing, to be honest with you. Matter of fact, I still think we're making up for some lost time, 21 through 24-ish timeframe that we're seeing happen again late 24 into 25. And I think that'll continue, quite frankly.
So if you see making up for lost time on capital investment, but you see maybe the potential for more margin pressure, does that lead you to think you'll see more issuance of debt? Is that sort of when you would, sort of upsize your leverage?
I can only judge how busy we are by the time the phones ring, and the phone rings a lot, and we're busy and we're doing a lot of new money issuances, and I do think that will continue. So again, I if you stretch that over the last 3 or 4 years, it'd be kind of averaged in every single year. But I think this has sort of been backloaded because we did sit on the sidelines for a period of time. Will we do more debt? Debt's still pretty cheap, no reason not to engage in that, quite frankly, if that's part of your capital plan. But I don't see any fundamental shift in the direction that we're going.
Yeah, Dan or Suzie, anything to do?
Yeah, I do think we're in a catch-up period. Looking at the data, a couple observations over the last few years. One, debt outstanding relative to the size of the organization. So if you measure it as debt to revenue, or even in some years total debt outstanding in the portfolio, has come down a little bit, and the debt to revenue number, measuring leverage against the size of the organization, has actually come down quite a bit over the last few years. So people really were, to Kevin's point, curtailing, and I think you're going to see that ratio come back up. There is a need for capital. The other thing that's out there, and Kevin kind of touched on this, is we've really seen a bifurcation between the leading systems, which are continuing to spend and have pretty healthy capital spending ratios, issuing new money debt. So on a weighted average basis, you're seeing those numbers grow. But at the other end of the spectrum, the capital spending really hasn't covered. We're still seeing a lot of spending sub 1x depreciation, or right around 1.0, which really isn't enough to keep up with a pretty capital intensive industry.
And I was going to say, I think to Dan's point earlier, that margins and cash flow for a lot of places hasn't really hit the targeted levels, like maybe leaning on the debt a little bit with all the maybe some capacity that's there. I think that we might see that a bit as well. And I will say, although, I agree with, sort of the stronger continuing to spend. I mean, we do have some credits that are a little more challenged because of maybe some spending they did. And so they've got these new plants potentially, but they're kind of under some pressure. So there's some pockets there where they've spent, but it's kind of gotten them in a little bit of credit issues. So. Yeah.
Dan, maybe circling back for just a second to something you just mentioned, I think something we've been observing is maybe the gap is widening between the stronger credits and the weaker credits. I mean, is that something you're observing in the portfolio?
Yes, and it's interesting because it doesn't show up, consistently in every data point. But I think one of the things you're seeing, so for example, sometimes on the margins, the cash flow margins, I mentioned the last few quarters have been trending the wrong way, but all things taken together, our smallest credits have started bringing the margin up. What had been, say, 2-3% cash flow margins are now 4 or 5%, which still isn't great, but it's not as wide a gap as we saw in the last couple of years. So that's good. But I think their options are really narrowing. They've not been investing much in plant for the last few years. So while it's a little bit of a wonky measure, we don't, maybe not the first ratio that we look at in rating committee, average age of plant for those credits has really ticked up. We're now seeing 16, 17 years is pretty typical for those smaller credits, and that's pretty high. I think portfolio wide, you're in the 11 to 12 range, so much higher. And they're getting to a point now where they really do need that larger partner, and their options are narrowing because the larger partners are, more discerning than they ever have been. And it's a buyer's market, and not everybody's buying.
Yeah, interesting.
Robert, you can also see that. I completely agree with Dan. You can also see that number a lot just in the margins itself. We usually throw it out there almost as a throwaway data point in our media and some of our reports. But what's the highest margin and what's the lowest margin? And I'm going to make up some numbers. It's like +20 to -20. I mean, it's a huge spread, so to speak. And a few of those are going to be outliers and things like that. But it just goes to show you, you never should say this, right? Some are killing it, and then some are really suffering. And so again, we've been saying trifurcate because the vast majority are just kind of going sideways or maybe a little bit better, but there are those at the ends on the extremes that are really, again, doing very, very good or really, really suffering. We're talking, negative cash flow margins, and that's hard to do, right?
So, and we're seeing on the balance sheet side too, like you see those stronger, much stronger, like as we've been starting to look at our medians, the dispersion there, whereas the weaker ones, they're not, they're not kind of making the strides as well as sort of those stronger ones, like sort of the wealth begets the wealth there.
Yeah. Well, so you know the next question then, right? So what do you think this portends for, more consolidation in the industry? Maybe Kevin, I'll get you to go first.
Yeah, so I mean, we started this conversation out with internally at Fitch, we've been calling it OBA, the One Big Beautiful Bill Act. It just sort of flows a little bit better. And I don't think there's anything pertaining to the bill in and of itself that increases M&A or disparages M&A. I think the prior administration, Biden administration, actively got out there and said, look, we're going to question M&A, and in particular for healthcare. We were the named entity that was out there, and Ken Kaufman would say, the old joke is everyone can merge except hospitals, that sort of thing. And I think you've had an administration change, so I think the administration change in and of itself probably loosens up the guidelines a little bit. This administration hasn't really taken a huge stance one way or the other, but they certainly seem a little bit more hands-off. Let the market decide, let the market do what it needs. So I expect we'll see more of a pickup to it. But I really think that healthcare providers have reached a maturation point out there, and we just don't see, well, why did you merge? Why did you merge? You keep asking that question, and when the answer finally is, well, we just thought we should get bigger. That's a terrible answer. That just doesn't work. If it doesn't work for good strategic reasons, which is why I think you're seeing what's been announced recently and probably what we'll see announced in the future, these have been well thought out, well planned, well timed, if you will. I expect them to go all of the way and not fall apart after a memo was signed or an LOI signed, something along those lines. And I think that's good for the market. We'll continue to see that with maybe a little bit of an uptick or a little bit of a pickup here. Less about OBA, more really, I think, just about we've moved administrations. We're a little bit more hands off, I think.
I think the only thing maybe OBA gives is like you. Now I'm going to start using that, Kevin. Is that it at least lets you know kind of what's the setting over the next few years, so you can start making decisions. Whereas maybe a few months ago it was everything was on the table. So that I think that maybe gives everyone.
Yeah, absolutely. Again, left arm, right arm. I keep talking about this, the guardrails. It's like if you are in like a huge Medicaid area and the state's already said, we ain't gonna help you, you're probably thinking, I need to merge, I need to do something. But not just to get bigger, but to solve a strategic problem, which is a flaw in my payer mix that I can't undo, I can't fix quickly without some sort of, again, BHAG, the big, hairy, audacious goal, which is a merger and sometimes like that. You now really kind of know that. Again, you've got that borderline to work with.
Yeah.
And I think we'll see some of the, like what we've been, like the ambulatory surgery center, like those big kind of, because those things are also on the table and are very strategic and important to players. So they may be kind of looking that way versus sort of a hospital, unless it makes sense in their market or, there's something strategic about acquiring another hospital system.
Yeah. Lisa, do you grab one of the questions out of the?
Yeah, and this gets to the capital spending catch up from COVID or capital spending to position for the future. How does that dovetail? Will there be any leniency from the three of you and your groups if margins ahead are going to be compressed, if margin pressure is ahead? So how do you marry the two?
Sure, I can start.
Yeah.
I mean, leniency isn't the word that I would use, but I think when we're evaluating large capital plans, we are used to seeing debt swell and leverage metrics really swell for the first couple of years, and that in and of itself is not. It's something we can get our arms around. We can get our, we can understand why, leverage will like if we measure it as debt to cash flow, why that's going to be outside of the target range for the next 2-3 years before a project comes online. So I think the question should always, or the discussion should always begin with what's the strategic rationale for this project, and then let the numbers fall out where they do. So it's not so much about being lenient about extra capital spend, but it's making sure that the rationale and the story behind the project is really solid, and then seeing where the numbers are. And there are cases where something is too much, one project or one organization is too leveraged for a rating category, and that's okay. We'll move you into the next rating category. And maybe that doesn't, feel good because it's a downgrade, but the reality is we're still behind the project strategically, and we understand your rationale for it. We just have limits as to what what we'll sort of tolerate within a particular rating category. But I think when you're sort of on that margin and you come and present a project that makes a lot of solid strategic sense, we're more likely to stay at the higher rating and watch the project unfold and see you come back into your normal range of leverage metrics.
Lisa, I think I agree with everything Dan said. I was so glad he went first because I wanted to hear what he was going to say. I think you almost have to break that question apart again. If you go back in time, before COVID, before life changed for us all, the number one reason for downgrades was a really big capital spend, right? It was a big borrowing or an extended period of spend. And all of us, I think, use the phrase, we don't rate to the highs, we don't rate to the lows, we try to rate to that natural resting place. It may move a little bit over time if you've got a huge plan for a period of time. And it's not a malicious downgrade. That's just a recognition that you're more levered or you're about to spend more cash and come down, if you will. And we need to, just like if I bought a second house, I have no experience with that. Day one after buying that house, I'm more levered, period, the end. There's no doubt about it. My metric should come down. And so we recognize that. But piggybacking off something, Dan said earlier, we've seen as well too, and Susie's mentioned as well, we've not bounced back like we thought. And the last couple of quarters haven't been as sharp as we would like to see. And so it really is two kinds of questions, I think. One is a debt question. Dan's right. Does it make sense? It's strategy, the numbers. And the other one is, I think we still have a lot of credits that we're finding out where the end of the runway is, irrespective of a big project, quite frankly. And if you look at some of our numbers whenever we publish the medians, you'll see that our upgrades, downgrades currently year to date are roughly 1-to-1. I won't tell you the exact numbers because I can't remember, but you'll see that negative outlooks have picked up for the reasons we've just been discussing. So I think we're still saying grace again if we've sort of, are we going to turn the curve or not? Are we going to right the ship, or pick a phrase that you like? But we're still struggling with that margin and that recovery. We haven't seen it just yet. And that's on top of maybe a big project, quite frankly. So it may not just because I'm doing a big project, big borrowing, it may be a combination of events.
Yeah, and do you have the operating kind of flexibility to kind of absorb the debt service and all of those things that are coming with that project? Maybe a different calculus now. And again, you think the project's beneficial, but if you're just not able to do it, or it's all because of non-op that you're able to make it,
Right.
It starts to bring into question if the rating is in the right place.
Okay. But having investment income, say non-op, is still good source of cash flow.
Absolutely.
Everyone agrees. Okay. Suzie, you mentioned capital. One of the writing questions is, what are the rating agencies considering a healthy, in quotes, healthy capital expenditure for an organization? Do you have a metric? We are in median season, so I don't know what you can, share for the preview, but go ahead.
Yeah, well, it's, less than one's probably not the right place. And it depends on your cycle and where you're at. So I think it's hard to say, we don't have a number. I'll just say that. There's no percentage. But I think over time, like we're at, and if you're in a growth market, right, it looks very different than maybe more of a stable market where you're just kind of having to kind of do the sort of bricks and mortar kind of renovations and things like that. So I think as we kind of see the average age, kind of understand what kind of needs there are, like what capacity there is, because we've heard a lot about capacity constraints at a lot of some of the higher acuity services. That's where we're asking about spending. And when you see that year over year average age going up, capex to depreciation kind of staying below 1, and no big project, nothing on the horizon, well, it might be okay for a particular hospital in maybe a small isolated area that, but maybe it makes you sort of draw some questions if you're more at a competitive market for sure.
Yeah. Good point.
Tend to agree. It's all based on your cycle, all based on your market, based on your market share. Susie's very frequently says, we do one rating at a time, one credit at a time.
Right.
And that's a big discussion point about it. Some people need to spend and can't. Other people can spend and don't. And other people can and do. And it just all depends on where you are in that cycle, quite frankly.
Yeah. And it just, Suzie, interesting comment. It seems like from what we're seeing, many hospitals are full, volumes are back. But the bottom line is not, as all three of you have mentioned. So what does that tell us? expense management, payer mix shift, all the above. So, but interesting. Yeah.
Yeah, it's still a contentious payer market out there. And I think they're under
Yeah.
some stress and potentially for a little bit longer.
Yeah. And actually, Suzie, that's yet another writing question about if the commercial health insurance plans are under stress and pressure, what will be the impact to hospitals?
Yeah, I mean, I think, I think the rate negotiations I think there's been some give back on or give as these organizations went through their higher inflationary period. But with the utilization and those kinds of things, I think those will continue. That might be a little bit more challenging as they go into that. Plus, I know there's been a lot of discussion about sort of the mechanics of those arrangements and how they're set up, and just trying to be better at that. So I do think it'll be a little bit more pressured as we go in, and the denials still are very high. I think organizations are being more strategic about who they partner with, especially on the Medicare Advantage side. It does seem like there may be better rates for Medicare coming into 2026, so that could be a beneficial thing. But I know somebody asked me, well, do we think that commercial is going to give more? I'm not sure they're going to give more rates. I mean, they may be kind of holding steady, but I'm not sure they're going to give more to offset some of the other pressures.
Lisa, for the last 18 months, I've been asking every CFO I talk to, is it getting any better out there with the negotiations? I'm like 1 for 280 or something like that. It said, it's not getting any worse. That was the best I got. And so I agree with what Suzie's saying. They're not going to be the white knight riding in and saying, money, 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 here you go. I mean, I wish they would, but that's not going to happen.
So let's just take this a little bit different direction then, because as you're talking about sort of money, I think clients are looking for every way they can access capital, right? And so one thing we've seen a whole lot of activity in is sort of this notion of what I'm going to call off-balance sheet financings, okay? Which I know we can take issue with. We see a lot of different flavors of this. Some are operating leases, some are deferred revenue liabilities, some are independents, SPEs, some are wholly owned SPEs. Dan, maybe we'll start with you. How do you view these structures? And just maybe talk about that first.
Sure. We view them, if it's a deferred revenue, for example, like you mentioned, there could be an operating lease or deferred revenue. We're treating it like it's an operating lease. So it's a debt equivalent for us. We're loading it into our leverage ratios and considering it an obligation that you've signed up for, in many cases, for 30 years. So it's part of the overall leverage profile. I think the question always becomes, what are you doing with the money? Assuming that it's raising extra capital for you. Are you just parking it on the balance sheet? Is it being spent on accretive projects? But from the standpoint, is it quote unquote off balance sheet, or would it be off credit? The answer is no. We're capitalizing it and putting it on the balance sheet and considering it part of the overall leverage profile.
So when does it become material? I guess we clients will ask us often, how much of this can we do? And I think that the answer is we'll tell you when it's too much, right? Because we'll know it when we.
Unfortunately, you're going to get the economist answer on this. It depends.
Right.
I mean, the reality is somebody could be coming to us with a proposed transaction, and they're coming at it from a pretty lowly leverage standpoint. Let's say call low leverage, say 20% debt to revenue, and this increases them to 30. Well, I think our national median is like 28% debt to revenue. I told you it's come down over the years, right? It used to be 33 to 35%. So, somebody comes in and this increases the leverage profile to still 30 or under. That's not really, in the when you take that sort of historical view, it's not really, an overly leveraged position. Of course, it's going to depend on the individual organization, where they are in their operating cycle, their capital cycle. But conversely, if you take this and, it takes you from 50% to 90%, that's a much bigger deal. So it unfortunately really does depend. There's no one size fits all answer other than to say it is on credit, it is on balance sheet.
Robert, I suspect you get questions, and Lisa, you probably do, about these as well too. Energy as a service, lease structure, all these things, and they're like sold, I think, a little bit as it's free money. And there just isn't such a thing out there. If there is a lender and there is a borrower, it's a debt equivalent, as Dan uses the phrase, and as we do as well too. You're getting payback, whether you want to call it energy payments or lease payments or debt bond service coverage payments. It's a payment for money that you were given. I mean, so again, it's a break it down to the simplest transaction you humanly possibly can. Is there a lender and a borrower? Yep. It's debt. It's debt equivalent, basically speaking. So there's no free lunch. I think they're largely de minimis and largely neutral, if you will. But the reality is, it just doesn't, it's not free. It just doesn't disappear or goes over to this other bucket, and we ignore it. We have to look at it again because there's a borrower and there's a lender there.
I'd agree.
Yeah.
And we put it, he said earlier this year. I mean, there, you get some expertise if it's an energy as service. So we get that, and it's a way to finance it, but it's on credit. And some of these have gotten, though, big. And so, and I think it's like any question of any debt issuance, right? Like, is it too much? That's something we'll have to evaluate as we get the information. But there are some bigger ones, and they're coming in kind of a little more funky than maybe they were in the past.
Can I ask you what funky means?
Just more like less direct, sort of going into some of the energy as service, maybe like putting some cash on the balance sheet, those kinds of things. So
good. Okay.
That's probably not a word I should be using with credit.
It's a technical term, right? Yeah. All right.
I think there was a song, something like that. Yeah. And when you look at these as debt-like, debt equivalent, are you viewing them as 100% debt, or is it 80% debt because it's not quite direct, or is it just all there?
No, it's all there.
Okay.
All there.
Okay.
There's some nuances around the rules about maybe the timing of when you have to spend the money.
Yep.
So, those are conversations to have, considerations, but at the end of the day, we're still considering it on the credit on balance sheet.
Same.
Yeah.
And do you see this as if you looked at debt and debt-like, is the debt-like portion for your portfolios growing as a percentage without knowing a percentage, or is it still a direct debt type of industry?
It's grown a little bit. I think percentage-wise, you're not seeing major movements. Operating leases certainly are a little bit more popular on the margins, but I wouldn't say it's this sort of wholesale shift. I mean, I think you've seen, these things cycle. There's, more appetite for private capital at different times, bank lending. Certainly there's been, on the lower end of the rating scale, more activity in, in actual private capital that's out there, doing collateralized debt obligations and repackaging and things, that kind of thing. But that's really minor. I think at the end of the day, it's still largely a public debt market. And when those markets dry up, when the private capital markets dry up, there's still public financing available. And I think that's what a lot of organizations still look to for their really long-term needs, especially if you're going to be in the market every couple of years or every year, and you develop relationships with the buyers. That's important.
The one thing I just add to that, I agree with Dan. It's increasing, but it's not hugely material. I don't want to come off as being, anti-creativity or something along those lines. I think for a lot of organizations, there's a lot of money tied up in things like real estate, where energy as a service, plants and stuff. And it's a creative way to unlock, unleash, and use some of those funds for something that you otherwise wouldn't have been able to do so. We're just saying, look, it's just not off balance sheet. That's, don't go crazy with it. But if you're unlocking a lot of cash and you're doing something creative with it, that's a positive thing. I'm not going to suddenly, double your cash load and say, well, it's that good. But the reality is, it's good for you. It's probably a good decision for you guys if you're trying to do that.
How much time do you all spend looking at equipment leases and finance? Does that ever rise to the level of scrutiny, or is that sort of lost in the numbers somewhere?
Equipment leases, you said?
Yeah.
It's usually not a big portion of the numbers, so
I'm gonna say lost in the numbers myself. Yeah. Could just be me, but I'm gonna go with lost in the numbers.
Yeah. Okay, that's helpful.
At one time, Robert, we were asking for, well, give us, a copy of all your major leases.
Right.
And after the 4 teraflops of data that showed up on my desk,
right.
I decided that's probably juice is not worth that squeeze, you know, kind of a thing to find out it's a 2 basis points shift. So we kind of stopped doing that.
Yeah. Well, I know we got about 10 minutes left. Lisa, do you want to switch gears again?
Yes. So we talked about median season, and we're all anxiously awaiting everyone's FY 2024 medians. Any interesting trends that you can preview or share with us? Kevin, we'll start with you.
Operating margins, just to stick with that, effectively tripled, so 300% increase, but still far south of where we would like to see it for a sustainable margin. Capital spending perked up by a good 20% year over year, more so at the higher end of the scale than the lower end of the scale, as one might expect. Generally across the board increases on balance sheet metrics and operational metrics. Again, not as much as you'd like to see, but if I had to get down to, I think Suzie alluded to this, and maybe Dan did as well, you know, we've got thousands of years of experience on credit committees at Fitch. And if you had to boil it down to just one measure, you know, which I don't want to, you know, get rid of that thousands of years of experience, you know, we'd say it's like cash to debt or cash to adjusted debt or cash to comprehensive debt, one of those things. That's at an all-time high right now. And so cash has gone up. There's been an increase in spending, but cash and spending have not kept pace. The cash, being the good part, really has outpaced the bad part, which is the debt part, if you will. And so that number probably going to stand around 170 or so as a global median, and it's as high as it's been since we started measuring it about 8 years ago. So that kind of jumped out at me, quite frankly, that despite the spending, balance sheets are really conveying a lot of credit strength still to this day.
And Kevin, in the weeds, your denominator includes all debt, debt-like, all debt?
Yep.
Okay.
Yep.
Okay. Yep. And, you know, we have to ask, can't help ourselves, days cash on hand going up?
Sideways.
Okay.
It'll end up 215, 220, somewhere around there.
Okay.
And other than that kind of aberration year of 2021, where a lot of people were holding on to lines of credit and extra cash that bolstered it, made it an outlier year, that level has been consistent in that, you know, 200 to 220 range for the last 3-4 years, and I don't see it really changing anytime soon, quite frankly.
Okay. Dan, do you want to give a preview?
Sure. As I mentioned earlier, the actual overall leverage for the portfolio is flat to down. So what I mean by that is the debt outstanding across the portfolio relative to the size of the organizations has been trending down. I think that's allowed the portfolio as a whole to maintain relatively stable leverage metrics as measured by debt to cash flow. So that's been pretty steady, but we're debt to have been maintained at the pre-pandemic levels of, say, 33-ish, 35% debt to revenue. The weaker debt to cash flow. We're seeing the same thing on the liquidity side. Days cash is relatively steady. You know, investment markets have been buoyant. So I guess when I peel back the layers of the onion, yeah, liquidity is stable, and yes, it's higher than it's been, you know, over a 20-year cycle, but days cash sort of barely kept pace with growing expenses. And I still think expense growth is just, margins aren't back. I think it's more an expense problem than it is a revenue problem right now.
And Suzie?
I think similar trends. I think the you know, the balance sheet's holding up. Same kind of thing with debt. I think that, you know, the margins, like I think we've all been saying, just not back to where, you know, improved certainly from the prior year, which I think we expected as we were looking at numbers, but just not to where I think where credits want them to be. But being supported with the non-op, which is great. So coverage has been really good. I mean, coverage is kind of back to typical levels. So that's a nice thing to see. But, you know, really looking in, and I think we're still seeing some variability across the country. You know, there's still some markets that, you know, when I just kind of pull margins from a particular region or state, you know, they're still kind of, you know, you look at the median, they're at a loss. You look at somewhere else and they're, you know, going like gangbusters. So we do see some variability kind of across the portfolio still, depending on some regions.
Okay. And we've covered so much today. There are certainly other issues besides OBA or the bill OB3, whatever you want to call it, that we haven't talked about today. So what else, keeps you up at night? Say, 340B, site neutrality, tariffs, what, kind of in closing comments as we head to the wrap up, what's out there that we haven't talked about that you're thinking about or committee is? Dan, we'll start with you.
Well, I think with the news yesterday, tariffs are maybe a little less off of my radar. I think it's still the contract cycles with the commercial insurers. I think that tension is just still there, and I think it's a generally contentious environment for not just the rates themselves, but the terms and sort of everybody playing well in the sandbox, good actors on both sides.
I think I agreed on the contracts. I think also the Medicare, just again, the payer mix is sort of moving that direction. They're starting to talk more about maybe accelerating some of the outpatient cuts that were kind of coming through anyway on the 340B. And then when they did the settlements, site neutrality, like all of those things, it seems to be, bubbling up on that side, which kind of on top of the contract end of thing on the commercial side sort of adds more pain on the revenue side there.
And they still all the good stuff. So I'm going to pivot on this. And you guys often frequently ask us, what do you want to see in a good rating agency presentation? And I think, again, OBA's done. So let's begin where we end where we began. We now have the ability again to put guardrails around what we think that our exposure is going to be. So I would say going forward in the very near term, maybe not today or tomorrow's calls that are scheduled already, but we really expect to say, here's what we think our exposure is, best case scenario, worst case scenario. Here's our mitigants we're going to put into place. Here's where we end up, if you will. And I don't think we could do that before. It was just too uncertain, too chaotic. Also, to Dan's point, throwing in tariffs as well, they're all over the place. I think it's settled down enough that we can actually put some serious game planning around this. Again, take those tabletop exercises, turn them into something that's actionable, strategic, and tactical, and then we can see what that does to the numbers. And that really helps us get some comfort the rating's appropriate, or, wow, you got, as we say in Texas, a lot of wood to chop. And we got to figure out, how that's going to impact the rating. So I think that's what we'll be looking for going forward.
Yeah, that's really helpful. Well, listen, with about a minute or so left, I just want to thank everybody for joining us. I want to thank our panelists. We appreciate so much your insights and all that you do for our industry. We appreciate our audience joining us and spending this time with us. Thank you so much. And with that, Jim, I'll turn it back to you.
Thanks, Robert, and thanks again to our panelists, to all of you for joining us today. As a reminder, you will be receiving a link to a recording of the webinar within the next day or two, and have a great rest of your day. Thanks.